Well, I want to welcome you to our continuing series of webinars, Leading Through Crisis, Risk and Opportunity on the Road to Recovery. These certainly are unprecedented times, and we've had to deal with many things on a moment-by-moment basis. I know that you've been through a lot personally, and I'm sure that everyone that is experiencing this crisis is having to cope with a new world and a new reality, and it seems like that world changes on a daily basis. So I wish that you have good health and are safe and are anchored in stability. I know that from our perspective as planning alternatives, we want to make sure that we give you timely information on topics that are real time and evolving as we go through this crisis. And that's what this webinar series has been about, the Leading Through Crisis session. If your audio is working, I want to say thank you so much, Jeff, for joining us. And by way of introduction, Jeff is the Chief Global Investment Strategist for Charles Schwab. He is no stranger to planning alternatives, and we're grateful that he has joined us today. Jeff has helped provide insight in previous webinars, and Jeff's focus at Schwab is to review trends and look at financial markets and help investors understand what's going on in the world and break things down so that there's an actionable plan that investors can implement in building their strategy to their future. Jeff has a Bachelor of Science in Business Administration from the University of Delaware, received his Master's in Business Administration from Pennsylvania State University. He also studied at the London School of Economics and is a Chartered Financial Analyst, CFA. I also want to recognize and welcome Jim Long, who's the Planning Alternatives Director of Investments. Jim is a CFA as well as a CFP. And many of you have heard Jim speak at our Outlook market commentary, and he leads our investment team to analyze trends and synthesize the best practice strategies using our fiduciary standard of bringing you advice that is in alignment with your best interest and in alignment with your overall financial plan. So I want to welcome both of you, and we'll have a kind of a fireside chat here of conversation. There's so much to talk about. I mean, I don't know where to start. And Jeff, I know that you have been in so many media outlets, Wall Street Journal, this morning on Bloomberg, I saw you on CNBC. So it's a real honor to have you available and participate in this event that's exclusive for our clients. We really value your expertise. So welcome, and you can also guide Michael on any of the slide changes that you need as well.
Yeah, maybe that's the best thing to do, since I seem to be unable to pass through the security firewall here of getting my cam up. And Nathan, you and I have done these in the past where you were able to see me, so I'm not sure what the issue is. I do apologize, but yeah, let's get started. I think we can talk a little bit about, well, we all know what this is like, so at least you can't see me, but you can hear me. So hey, we're not on mute, but the whole global economy has certainly felt like it's been on mute, just like so many conversations on conference calls. That's changing, right? The global economy is coming off mute, actually coming off in a pretty good way. If you just advance to the next slide, I just want to give you a little bit of a look back before we look forward. This is one of my favorite indicators for what's going on in the global economy. It's the Organization for Economic Cooperation and Development, OECD. You might have heard of them, a big global think tank. They put together this indicator of global economic activity. It's literally 45 of the biggest countries in the world. That blue line tracks what they're doing, and they'll tell you anytime this line's over 100, this is a 50-year chart, anytime the line's over 100, the global economy is accelerating, it's growing, it's picking up speed. It's below 100, it's slowing down. I like to watch 99. This chart was in every presentation I gave over the last year. Yeah, last year I was pointing to this because I was worried about 99. I had that line across there saying, look, this is a very important threshold for the global economy, and I'm worried that we're getting closer and closer to it, as we were last year, indicating that we were maybe getting late in the cycle. whenever we see those gray shaded columns, those are recessions. Whenever we get to 99, we're usually in one or about to enter one. And while didn't know whether one was imminent or not, certainly the economy seemed vulnerable. This didn't predict COVID-19, but it predicted a vulnerability to a shock. I thought the trade might be the shock might be trade or something like that. It in fact turned out to be this pandemic. And that, of course, has led to this deep decline in that line, every bit as deep as the global financial crisis. And I guess you could look back to the 1970s to see a very deep decline there. And of course, this one isn't over yet. So this was something that was sort of giving a little bit of a warning sign that we were getting towards the end of the cycle and vulnerable to a shock. And now we all know what that shock is. But the key from here is figuring out, what's next, right? How long is this? Is this going to be a big fat gray column or relatively skinny one, even though it's fairly deep? And I'm hopeful that it's a relatively skinny one. The next chart here kind of gets into what's really important here is this potential rebound we're seeing in a lot of the economic data. This speaks to how deep the downturn was. So let me explain this. All these lines are kind of in a little bit of a row, dots are in a little bit of a row. And what this is comparing is how deep the shutdown was, how much of a lockdown there was in these countries versus how much their economy shrank. And that's what we're seeing. So the more strict lockdowns based on this Oxford University Stringency Index were in Italy and France and Spain, where they just shut down the entire country. Whereas in other countries, you didn't get a national shutdown, like in Japan, which maybe had a state of emergency in a few cities. In the US, where part of the, half the states were shut down, half weren't, that kind of thing. So you see that spectrum there. Then you see the economic impact. So the number of points in the Purchasing Managers Index, kind of a timely indicator of economic activity, how much of the decline, sort of the massive plunge, and obviously way further out there, 40, 45 point plunge you see in Italy, France, and Spain. So they fell the most. They were suffering the tightest lockdowns. They have now emerged from those lockdowns, and we're starting to see the flip side of this, a more rapid rebound in economic activity in nearly everything we look at, relative to what we're seeing in the US or even in Japan. So let's go to this next slide. And I'm going to go through a couple of these relatively quickly because this is no surprise now. We know we're past the peak in new virus infections around the world, but I'll just give you a little history on this. So this is taking a look at the number of new virus cases in China. Now, we know that China initially had a cover-up, and during the period that Wuhan was shut down, really didn't have very good data. But we do see the pattern. So I don't know where this actually peaked out. We have data, but I assume the numbers were actually higher than this. But what you can see is that pattern of how quickly it came back down again, echoed by what happened in South Korea, where we do have very good tracking data, which happened 26 days later. So I just moved South Korea 26 days back, put it over China, and you can see both of them have really contained the spread of this virus since that. That's encouraging that we may not see a very big second wave. We probably will see some second wave, but maybe not a very big one. And if we advance to the next slide, we can take a look at what's going on within the core of Europe. Very similar pattern. So here for Germany, France, and Italy, new virus cases have come down very sharply, in line, kind of what we're seeing, what we saw in China, but 50 or 55 days later. And generally, this is what we're seeing. So Asia very much is now contained. And I'm talking about Japan, Korea, Australia, New Zealand, China. Now we're seeing that in Europe as well, the big countries and small countries as well in Europe. Where we're not seeing as good a level of containment is in the Americas, Brazil, Canada, Mexico, the US. This next slide is for the US, and you can, I'm sorry, this is Austria. If we just go one more, you can see for the US, just not quite the same level of containment, right? Not continuing to grow, but not the same kind of lockdown that we saw in those countries that really did aggressively shut down their economies. Kind of not quite the same effect. Hopefully this continues to decline, but this is a little bit of an outlier relative to Europe and Asia. But again, similar effect in Canada, in Mexico, and in many parts of Latin America as well. This is just an America's thing. We just haven't quite contained the virus spread to the same degree. So I'm expecting different pace of economic rebound. much sharper in Asia, starting to really see a rebound in Europe now, 50 to 55 days lagged after what we saw in Asia, and in the US and other parts of the Americas, not quite yet, right? We're going to get this jobs report here on Friday. 20% unemployment rate. We're still kind of in the midst of this, maybe starting to see some signs of improvement, but still fairly early in the recovery. So let's take a look at those recoveries. What I like to do is look at these heat maps. Yeah, thanks. So this is shaded for a lot of different indicators of economic activity. I'm going to quickly take you through these for a number of different countries, but we'll start here with China. China's greened up again. So green is good, red is bad. And we know China really hit the crux of their COVID-19 shutdowns right after right after the start of the Chinese New Year at the end of January. So all through February and then maybe to around the middle of March, they're really shut down. And you can see it in the data here. So I've got the number of cases, and then the Oxford Government Stringency Index was kind of an indicator of how shut down they were. And then you've got some indicators for the economy, weekly indicators that I can independently verify from data outside China. So the first one's air pollution in Shanghai, which is being measured by the US consulate in Shanghai using an EPA test. And you can take a look at where that really fell the most, meaning manufacturing was shut down the most, was there in February all the way through to early March. That's come back pretty well. Weekend box office is next. Like, how willing are people to gather together for entertainment? Cinemas have just started to reopen in China. In fact, they just reopened in Hong Kong 2 weeks ago, and those numbers are starting to pick up, but not yet in mainland China. We'll continue to keep an eye on that. No recovery yet, obviously. Then looking at people coming back to work. Nobody was working in February and into early March, but they have started to come back. Subway ridership and GPS-based rush hour traffic has come back nearly completely in all the major cities in China. So that's encouraging to see. Car sales. Car's a big ticket item. You've got to feel pretty confident about your personal financial situation, your job, etc., to really come back. And what you'll see here is now cars are, about 5% down from the sales pace they were at a year ago. But it's not bad. It's really not bad. China had been seeing slowing car sales for a year or so, and China's the biggest car market in the world. And so something close to what they're seeing a year ago isn't bad. Daimler-Benz, BMW, a few others have said, look, sales are roughly back to where they were a year ago, and they're amazed at how quickly they came back. Finally, so that's kind of a read on the consumer. And then finally, electricity demand, a way of measuring the service sector, flipping the lights on in hair salons and restaurants and bars and the like, and that's really come back as well. So I'm encouraged to see it. You'll see negative numbers there, but that's because we're looking at the coal inventory of power utilities, because I can measure that directly and independently, and that's why it looks like a negative number is actually a positive indicator. So I know I took a lot of time there, but the point here is China's green back up again. This is what a V-shaped recovery looks like. I don't know how sustainable it is. I don't know how representative it is for what we're going to see in other countries, but China was the first in and the first out. Let's compare it to a few other countries. If we go ahead one, we can take a look at what's happening in Germany. Obviously, the shutdown took place a lot later in Europe than it did in Asia, so you get a lot of green, and then you don't really get to the red until you get to late March and early April. I think it's really important to watch this on a real-time basis, and things have started to get a little greener. In fact, we've got real improvement here in commuter traffic, people coming back to work. We did get a little bit of a setback there in air pollution. I know we don't want to cheer air pollution, but it is, Germany's a big manufacturer, and when we do see, particularly around the bigger cities there, air pollution pick up, it is a sign they're back online. So a little bit of a setback in the last week, but I understand there was some unusual air currents and weather that may have disturbed that data. We'll have to see. Electricity use picking up, retail foot traffic picking up. I don't have the latest data point. It was delayed because of a holiday, but as I'm getting anecdotal reports of stores reopening, it looks pretty good. As a matter of fact, one thing we can look at is open table reservations. Open table, the thing you use on your phone to book restaurants. Well, we don't have data for every country, but we do have good data for Germany. And open table reservations are back to where they were a year ago in Germany, meaning as many people are booking online restaurant reservations today as they were 1 year ago. A full recovery in restaurant bookings. As a matter of fact, yesterday it was up 32% from a year ago, but there was a holiday. So really seeing a recovery in consumer spending, even in areas like going to restaurants, which is pretty darn impressive. Now, I'll take that with a little bit of a grain of salt, because now I think with restaurants only able to operate at maybe 60% of capacity, they're requiring reservations as opposed to maybe a year ago where you could walk in. So it's not necessarily apples to apples, but very encouraging to see that turnaround. There are other things we're measuring as well that are showing a bit of an uptick. Germany is starting to open their movie theaters, for example. Movie ticket sales are starting to pick up this weekend. We'll have to take a look at that. You can see the box office number still very red, but the start of an uptick there. That's encouraging. So that's Germany. I'll just quickly go through the next few here. France looks not quite as good. France has a bit more of a tighter shutdown. They're a little slower to loosen restrictions. So still a lot of red there, but we're getting into yellow. There's a little green there in terms of air pollution. So again, in real time, starting to see this data improve. And again, that's encouraging. We're about to get monthly economic data for the month of May. That's what we get reported in June. And it's going to show a pretty sharp snapback, pretty impressive rebound, not back to growth, but certainly coming off of what will likely mark the low for this recession globally, which was the month of April. April was the low point. So I think we're looking at a fairly skinny gray line, if you think back to that earlier chart, a very deep but very narrow and short-lived global recession. The recovery, the momentum, we don't know, looks pretty good early on, but we have to continue to watch this. Let's just jump to the next two. So we've got Italy here. Italy continues to improve as well, but a little bit at a slower pace, though you do see electricity demand coming back. You can go to museums and zoos and lots of different things in Italy now, so they are opening fairly rapidly, so we'll have to see how that progresses. So I'm encouraged by what I'm seeing here. Now, if we go to the next slide, I think it's important to recognize that this isn't everywhere, right? The US doesn't quite look like this. The UK doesn't quite look like this. Still a lot of red here. The UK, like the rest of the Americas, has had a little bit of a trouble getting their arms around the containment of the virus. So they've been slower to reopen, and we're seeing not as much progress there. So we're getting different shapes of recovery and different paces as we look around the world. Asia's way ahead. Europe is coming along, but the UK, Canada, the US, Mexico, Brazil, Argentina are definitely lagging. Doesn't mean they won't get there, but it might take a little bit longer, a few more weeks maybe, to get to that point, just because of the difference in the severity of the lockdowns in those countries. Okay, so moving ahead. The next slide, I think, is important to why, or is an important point as to why all of this matters for the big picture. This is correlation. This is what we don't want to see. We don't want to see this blue line up at the top end of this chart. All this tells us is how in sync stocks are moving around the world. Ideally, we like to have this low, like it was in the 70s or the early 80s or the 90s, where markets are moving and stocks are moving independent of each other. We get the benefit of diversification, but they've really shot up, meaning all the world's markets are moving up and down together in lockstep. So even though Asia and Europe are way ahead of the improvement in the US stocks are moving right along, right? We're definitely seeing a big recovery in US equities as well, anticipating this global economic rebound. Stocks are moving in lockstep, even if economies aren't. I don't know how long that'll be the case. We may begin to see different markets behaving differently in response to how their economies are faring. But right now, the entire world is just trading as one big stock. It's up or down based on how the economic data is coming in. And I do think that the economic data for the month of May that we get in June should look fairly good. Not that that isn't already priced in to some degree, but I don't think it'll disappoint investors. So let's move a little bit further. One of the other reasons that this all looks so good is because we've had the guardians of the economy, all the world's central bankers and leaders on fiscal policy really pumping a lot of money into the global system here. Absolutely unprecedented amounts of stimulus. Japan, between their first stimulus package and now the second one they're putting together, the amount of stimulus they're applying to their economy is equal to 43% of GDP. Germany, 62% of GDP. I mean, these are unbelievable numbers. In the US, we're looking at like a 12% of GDP number, and that's going up. Could be 16, could be 18%. These are huge, huge numbers. And as opposed to the great financial crisis where the money was pumped into the banking system to ensure banks could continue to lend and function, this is checks being mailed to people. This is, businesses being directly supported by loans. So it's much more directly being injected into the economy and having much more of a direct and impact. And I think we're seeing that show up in the data. And one of the reasons why we're seeing a number of countries where the unemployment rate's really not moving up very much. I know on Friday we're going to get the unemployment rate in the US. It's probably going to be around 20%. But we already got the May unemployment rate for Germany today was 6.3. It went from a low of 5 at the start of this year, just 6.3. That's not too bad. In Ireland, we also got Ireland's unemployment rate for the month of May last month, and that only went up slightly as well. So most of the world is seeing like a 1% rise in the unemployment rate. The US is kind of an outlier in all of that. And one of the reasons for that is because there's a lot of stimulus and a lot of programs designed to those social safety nets in Asia and Europe that's helping to support the global economy, but just an enormous amount of money being spent relative to other downturns. And that is certainly having an effect. I don't know that that the market should have as much confidence that the Fed can address these kind of problems very effectively. It's a healthcare crisis, not a banking one, but certainly on the fiscal side, the loan guarantees, the payroll protection program, a lot of the things that are being done in terms of direct injection of stimulus do seem to be working and having an impact on sustaining businesses, avoiding bankruptcy, and retaining payrolled employees, at least outside of the US. Okay, now let's get to some of the conclusions here. We'll move forward to the next slide. You've seen this before if you've heard me present before, because I've been using this chart for 20 plus years. This is the yield curve. Now, you probably got sick of hearing about this last year. Everybody was talking about the yield curve because it inverted. What is the yield curve? What is an inversion of the yield curve? So if you take a look at this chart, I'm referring to the blue line. And that, well, they're both blue, but the jagged blue line. And that is the yield curve. It's a difference between long-term interest rates and short-term interest rates. It's the 10-year yield minus the 3-month yield. Usually, longer-term interest rates are higher than short-term interest rates, right? A 30-year mortgage rate is higher than a 3-month CD usually, but not all the time. Sometimes it flips and long-term interest rates drop below short-term interest rates, as they did last year in the summer. And it's usually a warning that the economy is imbalanced and vulnerable to a shock. And what you've seen is this has happened. I marked it with a little orange dot. Between every one of those gray columns we know are recessions going back over the last 50 years or so. It's been a pretty good indicator that there's a risk to the economy. Well, last year I was pointing to this, maybe less about a risk to the economy, while we were saying it was late in the cycle, but more the sign of a turning point of a new cycle. An opportunity as much as it is a risk. Every new cycle comes with new market leadership. Always been the case. New cycle, new leadership in the markets. It's been a long time since we've seen that, right? It's been 12 years since we've entered a new market and economic cycle. So we're kind of used to this old leadership of US and growth stocks just leading the way again and again, year after year. That may be set to change. And let me show you, if we go to the next slide, I'll show you how this yield curve can be a real important indicator of this and what we're likely to start to see. So this is looking back at the last 25 years between growth and value stocks. Now, growth stocks, you pay a lot for them, but they're growing very quickly, right? These are classic tech stocks, for example. Value stocks is the orange line. When that line's going up, value stocks are outperforming, which tend to be companies that are maybe slower growing. You're not concerned about how fast they grow. You're more concerned about the price you pay. You want to buy them when they're cheap. And these styles tend to move in opposition to each other. And that's literally what you're seeing here. They're mirror images of each other. In the late 90s, you can see that blue line going up as growth stocks led by the tech sector were really strongly outperforming and value stocks were underperforming right up until we got to that yield curve inversion in 2000, just ahead of that 2001 recession. That was a sign that things were about to flip. We were about to get new leadership in a new cycle. And sure enough, value stocks began to outperform, led by financials, a classic value sector, all the way through that financial bubble, the housing bubble, right? All the way up till the end of 2006, beginning of 2007, when the yield curve inverted. Now, the market didn't peak out until late in 2007, but about a year before that, you started to see a reversal in performance. You started to see, just ahead of that '08 recession, we started to see this flip. New leadership emerged. Growth stocks began to rebound, led by technology again. And I've got 50 years of data. I could show you this has happened every single time. But here's where we are now. Gone through that yield curve inversion last year, sure enough, right into the recession here in 2020. Now you'd expect to start to see a reversion, start to see new leadership where value stocks will begin to outperform, not just over the next year, but maybe over the next 10 years. But look what's happened in the last couple of months. We've seen the opposite, right? Why? Well, healthcare is a growth sector. Energy, on the other hand, is a value sector. We know what happened with oil prices, and we know what happened with demand for healthcare. So this, instead, the old leaders got new momentum as we went into the downturn, really expanding this valuation gap between growth and value stocks. But what I haven't updated this chart for is what's happened since March 23rd. We've started to see a turnaround. Cyclical stocks have started to outperform. Energy, believe it or not, is now the best performing sector since March 23rd, since the low. And we've started to see over the last few weeks, really over the last month or so, sectors like financials and industrials, value sectors, begin to lead the market. Whereas tech's done okay, but it's been more of a market performer rather than a leader. So we've started to see this shift in the last 6 weeks or so begin to play out. Again, this could be something over the next 6 years, right? So I think it's time to start to see this shift. And if you just advance this slide, you'll see I've got the same chart here for a few other asset classes. And this is the difference between large and small company stocks. Real quick, same pattern. You get these reversals. And what we've seen over the last 10, 12 years is smaller companies outperforming larger companies. But that started to reverse as well. We've kind of gone through this jagged period for the last year or two. But I think we're starting to see a period where larger companies are beginning to outperform. And then finally, US versus international stocks. This is a really interesting one. I took the chart back another 10 years just to show you a period where international stocks outperformed US stocks by the same degree US stocks have outperformed international stocks lately. And you got to go back to the 80s to see that, back when Japan was going to take over the world. And back then, the Nikkei was rising and Japan was the place to be. And you'll see that blue line was rising. That's international stocks outperforming. And then we got a yield curve inversion signified by that blue column there, and a recession in 1990. And that flipped the switch. And then we started to see US stocks outperform. It flipped again and again. And in the last cycle, since 2007, where we got the last yield curve inversion and the '08 recession, US stocks have led the way. But here we are, another yield curve inversion in 2019 and recession in 2020. I think we're about to see this flip as well. International stocks tend to have more value sectors as opposed to growth sectors. So if we see that switch flip over towards value, we're probably going to see international stocks begin to outperform as well. So maybe it's time, a new cycle, to get new leadership. And I just finished maybe with this next slide here, which really shows this beginning of this turnaround in cyclical stocks. Like, why haven't we already started to see this flip? I've been talking about this for a year, at least a year, maybe 2 years, and saying, watch for the next cycle. We're going to see this flip towards international and value and larger company stocks. Why hasn't it already taken place since we hit that low? Should we already be seeing it? And the truth is that cyclical stocks lagged this recovery uncharacteristically, but that's starting to change. So what you're looking at here is cyclical stocks versus value, almost value versus growth, right? Usually value stocks, those that are economically sensitive, tend to be the ones that rebound off of the market low. We're looking back at the low, back after the tech wreck, the big tech bubble, which the markets bottomed back in 2002, and then again the bottom following the global financial crisis back in 2009. This is the difference between cyclical and defensive stocks, right? So you can almost think of it as financials or industrials versus healthcare. And usually those more economically sensitive stocks lead the way. And at this point, 40, 50 days into the recovery, well, usually up 10% or 30%, these economically sensitive stocks are outperforming defensives, but not this time. In fact, for much of the initial stages of this bounce back in the market, it was led by defensives. Very unusual, not something we've seen before. And that held back value stocks and held back the performance of international stocks. But that's starting to change. In the last couple of weeks, we've now broken out. Cyclical stocks are beginning to outperform. And sure enough, as we're seeing today and yesterday and last week and the week before, international stocks and value stocks are beginning to lead. That's encouraging to me, not only in that this is what I'm expecting, new leadership in a new cycle, but also it validates that maybe March 23rd was the low. Because if we've got defensive leadership off of the low, I'm questioning whether that really is sustainable as the low for the market. But as the market's beginning to embrace more cyclical stocks, it's beginning to start to feel like maybe the market is granting a little bit more validity to the 23rd as a low. And getting a new group of stocks, fresh leadership to the market is important. Tech stocks have done the heavy lifting for over a decade. It's good to see new sectors begin to lead the market higher. It's kind of a second wind to the rally, if you will, and maybe one of the reasons why we continue to make new gains here each day. It's on new leadership, and I think that's fairly important. So let me stop there. I covered a lot, but I know I got started late, and so I want to see, Jim, I'm sure you've got a lot to say, and I'd love to hear from folks as well.
Thank you, Jeff. Jim, maybe you could provide some insight in terms of what we've been working on at Planning Alternatives to navigate this crisis.
Sure, Nathan, and thanks for everybody joining today. And Jeff, thanks for your comments too. I'd like to highlight 3 areas where we've been beneficial. First is just to serve as eyes and ears for clients who trust us to be the advisor. Jeff touched on, the economy and recession. Bear markets usually take the shape of one of 3, or caused by one of 3 things. The Fed getting ahead of themselves with raising interest rates, causing a yield curve inversion and causing that. There might be a systematic problem like we had in 2007 or 8 with the housing market, or you might have a downturn caused by a one-off event. And for us, we felt very strongly at the beginning of this that the virus was a one-off event. And because the economy was really strong going in, that hopefully we'd be able to recover pretty quickly. So for us, it was trying to counsel clients on, this is the nature of the downturn. These are the things that we think are going to happen coming off of it. And we're wired as investors to be scared or afraid, or we're damaged more by losses than we are by equivalent gains. So first and foremost, it was to serve as the trusted advisor and make sure that we were counseling people through this tough time. Secondly, I wanted to highlight our efforts to rebalance portfolios. So what does that mean? As stocks went down precipitously and bonds were sold off, but then recovered pretty well and were good performers, accounts tended to become a little bit light on stocks for what sort of risk budget they were in. So a traditional 60-40 portfolio might look more like a 53 or 54% stock portfolio. We took the opportunity to trim out of the asset class that was performing well, bonds, and buy the asset class stocks that were underweight and that hadn't performed as well. And that's important to Jeff's point, because as internationals had kind of lagged, or some of the other sectors of the stock market, it was good for us to buy those at a relative low and not only get clients back in the right asset allocation, stocks versus bonds, but within stocks, we wanted to have the mixture of US versus international be good. And thirdly, we've taken the opportunity in this crisis to do tax loss harvesting where it made sense for clients. So realizing some losses that we can put in the bank that later on, if we realize taxable gains, would help us offset any negative sort of tax implications. So the 3 instances: serve as the trusted advisor, take this opportunity to rebalance portfolios, and tax loss harvest when it's been appropriate for clients. Those are the 3 biggest things that we've done in the midst of this pandemic.
Thank you, Jim. Jeff, I'd like to pose a question that we get from in a number of conversations. We seem to be bombarded by very intense negative news, economically, politically, societally. How, even this conversation about thinking about a rebound and looking forward and seeing the advances of the market, why is there such a disconnect between the market and what we're facing in our lives each moment?
Yeah, it's a great question. Stocks generally, well, they look forward. There's never really been a correlate. We just talked about how bad the unemployment situation is, and certainly I think that contributes to social unrest as well. And there's never been a correlation between the stock market and job growth. Seems like there should be, but there isn't. Whether you look on a month-to-month basis or a year-over-year basis, and the reason is that the stock market is forward-looking. It's looking towards a recovery in jobs, a year or so from now. I mentioned previously, I think I talked about how jobs didn't bottom until February of 2010, after the last financial crisis, the last major recession, even though stocks bottomed a year earlier than that, anticipating that recovery in jobs. So I think that with everything that's going on, I think markets are looking through it. Now that doesn't mean markets are right. There could be lingering consequences of the U.S.-China trade battles. There could be lingering consequences from what goes on with the election. There could be lingering consequences of the current social unrest and protests going on here in the U.S. over George Floyd, over Hong Kong, over Chinese rule, so many things. But the market is looking at these things and say, we've seen a lot of this before. We know there's an evolution of these things, and we move on. And that's where the market's focused at the present time. Again, could be wrong, but looking at real-time data, these recovery data points that I spoke to, I think is what the market's really keying off of, on the idea that earnings will begin to recover, over the second half of this year into next year, and that's really the driver of stock prices, much more so than anything else. It's not that Wall Street ignores Main Street; it's just looking at what it hopes will be what Main Street looks like a year or so from now.
And Jeff, is there any historical perspective on how the markets interpret or can interpret the unprecedented level of stimulus that's been poured into the economy? It seems like the floodgates of stimulus bills or fiscal policy, monetary policy combined, you mentioned up to maybe 15, 16% of GDP in the US, which is just incredible. What are your reflections on that? Is there anything in past history that we can look at?
This is so beyond anything we've seen, Nathan, that it's difficult to put any prior comparisons to it. It's just absolutely enormous. Now, when we look back, we can see periods where this for some countries this led to challenges. Essentially, we're not actually funding this with debt. We're really funding it with currency. I mean, essentially, the Treasury is issuing debt to fund this deficit, which is immediately being bought by the Fed, essentially using the banks as a conduit. So the government is selling debt to the government, who's then passing the interest payments, the Fed, back to the government. And so it's really about an expansion of money. Now, this isn't what happened during the great financial crisis. It was a bit different than that. The private sector actually bought the debt as opposed to the Fed. And there aren't a lot of comparisons going back. I think ultimately what should come out of this is a bit more inflation. That's not a bad thing. We've been battling fears of deflation for a long time. Deflation can have destructive consequences, just as too much inflation can. I think the key for the Fed is, what's that sweet spot, right? So right now they're not too worried about inflation, but the expectation of most forecasters is we're going from like 0.5% inflation right now to maybe 1.5% inflation a year from now. That's not a bad thing. But if it was 2.5 or 3, just think where interest rates would have to go. We already had trouble getting businesses to invest when interest rates were at historic lows in the last couple of years. Interest rates could go to 4 or 5% on corporate debt. Would businesses be willing to invest at those levels, borrow at those levels, I don't know. It could make for a miserable recovery. So I worry a little bit about interest rates going too high as a consequence of expanding the money supply to this degree and leading inflation higher. At the moment, I think the Fed has enough tools to pull back that they could restrain those inflationary tendencies. But that is the concern here. What do we do with all this debt, essentially the money that we've created? Already we've started to see a recent weakening in the dollar. Could that become a much larger trend, a much weaker dollar? And the consequences of that on import inflation would be significant. So a lot of things we need to watch. Those are more a few years down the road. I think right now the Fed and fiscal leaders are probably doing the right thing in addressing the crisis the way they are. I just hope they have the tools and the ability to begin to pull it back if and when we do start to see inflation begin to pick back up.
Thank you. There's a couple questions coming in from our audience. I'll ask you, Jeff, do you expect, what letter of recovery? Are you expecting a V-shaped recovery? Do you expect recession risk to continue in the next 9 to 12 months? And then Jim, I'll turn over to you after Jeff to talk about what is on your dashboard for the planning alternatives clients and portfolios.
I think to sum it all up, Nathan, all of the above. I think different countries and different industries will be going through different shapes. Some will be V-shaped, some will be U-shaped, some will be L-shaped. In fact, I just out on my Twitter at Jeffrey Kleintop, I just put a chart today that shows V, U, and L-shaped different recoveries in retail sales happening right now. If you look at Sweden or the UK or the US or Spain, number of different countries on there, different approach. And so I do think we'll see a bunch of different shapes. That isn't necessarily a bad thing. I think broadly what it suggests is a slow and deliberate recovery for the overall economy over the coming quarters. So I'd be worried if we got too quick of a snap back because I think then that's vulnerable to kind of a W shape that maybe if we all come back too quickly, maybe we get a second wind to the virus, we get a number of different things and we have to pull back again. So I'm encouraged by what I'm seeing and tracking it on a weekly basis. I don't want to say that we've got a very confident forecast. We're going to watch the data and go with what it tells us. But because this is such an unprecedented time, but I do think there'll be some industries that really have a very difficult time recovering, others that are already in the midst of a very strong snapback, and others that are going to take some time. In some countries, that'll be the case as well. Again, huge, deep job losses in the US. Hopefully they begin to come back fairly rapidly, but what we're seeing in other countries, maybe they didn't see the same quite the same degree of job losses, and that the consumer seems to be holding up a little bit better there. So again, different industries and different countries recovering at slightly different paces.
Thank you. Jim, what do you have on the dashboard for the planning alternatives portfolio?
So for us, Jeff mentioned, number one, what's called so-called high frequency data. And Jeff mentioned some of these things about box office receipts and transportation data and gasoline and rail car and all these sorts of things that get posted very regularly and continuously. It's not a lead pipe cinch that this is going to tell us exactly what's happening in the economy, but it is going to give us some insight, and it does, as to how quickly things will recover. And I've even seen Nike swoosh as another possible recovery situation or uptick in the graph. So I would say high frequency data to give us a little bit of an indicator as to what's going to happen in the economic recovery. Certainly the unemployment numbers and the official economic stats that come out and corporate earnings, with the caveat that corporate earnings in the US, 40% of the S&P 500 have pulled their visibility or their outlook for earnings for the rest of the year. So we need to be careful with looking at earnings as a sole arbiter for what we think is going to happen in the economy as well. So those two things. The only other thing I'll mention on stock prices, since they've recovered so fast, so quickly, or so far so quickly, is that when this does happen, usually there's a choppiness in trading after that happens. You're going to go through a period of extended volatility, or you'll have some what's called consolidation, where it doesn't just continue to ramp up and go on and on and on upwards. And there's any number of things that could be setbacks potentially: the virus, the social unrest, the unemployment numbers becoming positive or permanent rather than, let's say, temporary. You have all of these sorts of things that could be a negative to the recovery. So we're watching all of those indicators as well.
Thank you. Well, as we come to the top of the hour, I want to thank everyone for joining us today, and we'll be wrapping up. And Jeff, I'll ask you for final comments, and certainly appreciate your time. We value you attending this webinar, and this is for you. It's been an exclusive webinar for our clients. We are here for you. We've talked to many of you over the last few months as we've navigated this crisis together, and we're fully committed and completely here for you every step of the way. One of the ways that we are giving back during this time is that we're offering complimentary consultations to anyone that you know that may be in need of financial guidance and advice. There's no strings attached. There's a lot of change. There's a lot of displacement going on in the economy and people's lives, and we want to be fully available for your friends, your loved ones, your contacts, and feel welcome to direct them our way. And our great advisor team is ready to help meet people wherever they're at in their personal situation. Jeff, it's been a pleasure having you join us today. I want to thank you for investing time into us and sharing with our clients, and I'll ask for your final takeaway.
My pleasure, and this has been really great. Thanks for all the questions. I guess one thing I'd say, when we go through periods like this, I think often people think, maybe the safest thing for me to do is just get out. Is just step back and wait till the dust settles. The problem with that is, by the time the dust settles, you'll have missed the recovery. And this is how people make mistakes. Look, I think back, March 9th of this year was one of those big down days, a 2,000 point down day in the Dow. It was one of the biggest down days that we had. And I remember that day, and I got so many calls and questions about, should I just get out? And I thought back to 11 years prior to the exact day, March 9th of 2009. That was the day the market bottomed after that 50% decline during the great financial crisis. And you know what happened that day? Nothing happened that day. There wasn't even an economic data release that came out that day. There was no fanfare. There was no official announcement that everything was over. And I think if you polled people that day or week or month and said, hey, do you think the worst is over? They would have said, absolutely not. Definitely the worst is still yet to come. Yet there you were. That was March 9th. By June 1st, stocks had rebounded 41% off of that lows, and they never looked back, never retested those lows. We know, kept moving higher. And that's the thing. I think getting out requires two decisions, right? It's the decision to get out, then the decision to get back in again. And that's the hardest one. And that's why we always advocate diversified asset allocations. They can help manage volatility during these very difficult, stressful periods of time where we don't know what's going to happen next. And I think in contrast to the viewpoint that if you don't know what's going to happen next, you should get out, I think the opposite. You'd have to have an enormous amount of confidence you knew what was going to happen next to abandon your financial plan and abandon your asset allocation and take matters into your own hands and just get out. So I think that's often in the back of people's minds, whether they ask it or not. Should I get out? Should I not? It's never the right answer. And just because that second decision is so hard of getting back in, and so few people do it. And I can tell you, and I'll just sum up with this, across Schwab, we've got every trade made at Schwab going back to 1976. We have all this data to show that individual investors, when they don't have the benefit of professional advice like they do from you, Jim, and Nathan, and the other folks at Alternative, they tend to make these decisions. They jump out at the wrong time and they don't get back in. So, I really think I think it's wonderful that you all on this call have chosen very smart investment advisors and you've stuck to your plans. That makes all the difference in reaching your financial goals. Sorry, this was a long comment, but it's something I think it's often in the back of people's minds, even if they don't ask it directly. And I think it's one with a very obvious and high conviction answer.
Thank you, Jeff. Thank you, Jim. Thank you, everyone, for attending today. We are available for you, and we'll be we've recorded this webinar, so we'll be sharing that in future communications as well. In the meantime, stay safe, and we look forward to seeing you soon. Have a good day.